Hey folks, Andrew Packer here. Welcome to Trading Tips. When it comes to investing, I'm a big believer that you make your money when you buy, not when you sell. That doesn't mean you can just buy something and sell it right away. It just means that if you overpay going in, it can lead to some serious problems and impact your returns going forward. Now, a lot of companies, when they do mergers and acquisitions, which is a big news thing, they tend to get into some hot water over this issue because in order to acquire an entire company, they typically have to pay a premium. So if shares of a company are trading at 60, the acquiring company might have to offer 75. So that extra $15 price difference that they have to pay, this extra premium, becomes an item on the balance sheet after the merger called Goodwill. And that can sometimes lead to some unusual things. Now, if this company that was trading at $60 was going to continue to grow and become a $100 company a few years down the line, then the Goodwill paid, would have covered itself over time. But, if this value never materialized, if it always stayed around 60, there would still be this overvalued level that would have to be written down. So sometimes you see companies announce a Goodwill write-down, and sometimes that can have a big impact on their share price. And that leads me to Kraft Heinz, ticker KHC. Kraft Heinz recently did a $15 billion Goodwill write-down over its merger. And they were basically citing the fact that, hey, putting together food and condiments sounds like a great idea on paper, but the fact of the matter is we overpaid. Now, as an investor, every time there's a Goodwill write-down, typically the stock should drop by the amount of the Goodwill write-down. So $15 billion write-down is huge, and this had a huge impact on Kraft's share price, going from the 40s to the low 30s pretty much immediately. But the share price has been kind of lagging a bit, and the market had been a little weak going into that. But that said, shares are kind of starting to look a little bit like a buy right now, and that's for a few reasons. First, the Goodwill write-down just put a lot of pessimism into this company, into the deal. A lot of people have a much lower expectation of it going forward, even though they should have had a lower expectation going into it, given the premium they paid going in. Again, it comes back to this whole idea of making your money when you buy. And when you look at companies that tend to write down their goodwill or even cut their dividends, as Kraft has done, every situation's a little different. So even though there's been this big write-down, the big and most important question in any of these situations is the company likely to go bankrupt? And while the combined Kraft Heinz entity does have a lot of debt and they do have to use a lot of their cash flow to service that debt, the slowdown in that business really hasn't been necessarily huge. It's just been that they haven't had the kind of growth that you might have expected even from a big mature company. You would still expect, maybe 5 to 10% growth rates in sales and revenue every year, and it's been much more on the lower end. But this isn't a company that's necessarily on the verge of collapse. This isn't a company that's, going to have to continue to pay out more than 80% of its earnings in debt flow or higher, which would be a huge sign of distress. So just looking at this specific company, it's not going bankrupt, and it is still to some extent a blue chip. But we also need to recognize the fact that the branding power in the 21st century is just not what it used to be. There's so much more competition, and so many more people want to try different products. And when you can have just about every conceivable product shipped to your home with no risk, it's putting a lot of pressure on brands. People just don't interact with them the way they used to in the past, as sort of this immediate recognition and, hey, I should be willing to pay 10 or 15% more for a Heinz bottle of ketchup over a generic store bottle of ketchup. People might be willing to shop around and they might find something they like better. So given the fact that brands are a little bit under pressure as well, this is the kind of situation where, it's not necessarily kind of that slam dunk buy. But looking at shares right now under 35, I think they'll do all right going forward. With the bad news priced in and with the possibility to move higher, typically the pessimism that a lot of these companies see after these write-downs lead to some market outperformance over time as a result. So if you were looking to trade this, I would look to buy shares. Some people in these situations like to buy call options, go out and hope that things can recover from there. The problem with that, though, is you're kind of going to be in this dead space for a little while where the share price just kind of languishes in a narrow trading range. That's what we've seen for the past few months. But again, from a trading perspective, we've stopped seeing the company make new lows. And that's usually the first sign that things have stopped getting worse. So that's a good sign to get in. It's not necessarily a sign that things are going to pop right away. But the share price is starting to just very, very, very modestly inch higher in the past few trading sessions. So I think this is an attractive name to look at now. especially if you're the kind of investor who's always said, yeah, I just want to invest in blue chip companies. The best time to buy them is when they're dealing with these kinds of fears and these kinds of accounting issues that don't necessarily have to affect you. So looking at it as a whole, I would definitely look at buying shares of Kraft Heinz at or under 35 and just kind of treat that as not necessarily a buy and hold permanently investment, but the kind of investment that is probably going to do better than the market. And because the company is having this stressful event now, the next time the market has a sell-off, it will probably be somewhat immune. If the market goes down another 10 or 15%, shares probably aren't going to go down by as much as that. They might go down by 5 or 6% or some other smaller percent. That's just going to give you the sign that everyone who's kind of wanted out of this position has already done so following the big sell-off. So look to buy now while things are still in this post-drop flat line. And don't necessarily get too greedy on the other end. I mean, if sales are going to continue to be slow, this is a stock that's probably going to go from 35 to 40 in a year. That's going to be a good percentage return, but it's not necessarily going to be like 1,000% return. But these kinds of returns over time, especially with blue chip companies, can add up and be a huge part of building and growing your wealth. So that'll wrap things up for this edition of Trading Tips. Until next time, I'm Andrew Packer, wishing you good trading and good financial health.